Hey guys, it's Chris Mincolla with the Mincolla Group over at West USA Realty. I'm doing our housing weekly market update. And well, we had the Fed meeting yesterday with Jerome Powell and the gang. And I tell you, I'm going on a rant today. So if you don't want to hear the rant, you don't have to hear the rant. You'll get some good information too and understand really what's going on and why um, they lowered the Fed's fund rate, but why did mortgage rates actually go up? So, and we'll get into some other stuff in the local Phoenix economy here and housing market. So, um, really quick, I'm going to share my screen here with you and jump right in. So, I wanted to show you this first because I've been saying this, and other people want to fight me on it, but let's just take the word of some the economists basically across the entire country. Daryl Fairweather over she's the chief economist over at Redfin. Again, I don't always take what Redfin has to say as gospel truth or anything, but it was really interesting that she shared recently that she was at, I'm not going to play the video here, it's too long, but National Association for Business Economists Conference. She was at that conference and she wanted to know, what do you think's affecting the economy more than anything, as far as, you're concerned as economists and business people, is it AI? What is it? And actually, the answer she got from an overwhelming number of the economists and business people there was the Fed fund rate. And this is what I've been telling you, for a long time now. When inflation went nuts, with all the stupid spending that they were doing, a few years back, and he had super high demand with a huge influx of immigration going on, and you had supply chain issues all at the same time. And then after that, late in the game, they raised the Fed's fund rate. So everything across the board was a perfect mix to make everything more expensive, including housing. But there you go. The Fed's fund rate, okay, and what the Fed is doing is basically affecting the economy. And you can't have it both ways. You can't say Jerome Powell's doing a great job, but the economy, when it comes to housing affordability, the affordability of everything, the inflation rate that we've had was all the way up over 9%. If you kind of calculate things the old way, it would have been double that. But when we look at this, and I just thought that was super interesting and an insight into what was going on here. I'm going to save you from having to listen to Jerome Powell because it's like watching doom gloom paint drying. But here's the quick look at the official statement here. And he it starts off with the announcement here, and I'm not going to read the whole thing, but available indicators suggest the economic activity has been expanding at a moderate pace. Job gains have slowed this year, and the unemployment rate has edged up but remained low through August. Okay, because they don't have the other data because of the government shutdown. Now, keep in mind, since the end of 2022, it's been labor over inflation as far as Jerome Powell and the Fed is concerned. So, more recent indicators are consistent as far as the rate cuts concerned. More recent indicators are consistent with these developments. Inflation has moved up since early in the year and remains somewhat elevated. Although we just had an inflation report and it came in lower than expected. And we're going to look at some other stuff here that basically tells us what we already know. Jerome Powell is looking at old, outdated data and the wrong data. The committee seeks to achieve maximum employment and inflation at the rate of 2%. Okay. So basically, in a nutshell, this thing tells us that they're lowering the Fed's fund rate a quarter percent, which puts it at, the overnight borrowing rate at banks, basically at 3.75 to 4%. Now, that has an indirect correlation, but it has an effect on mortgage rates. More importantly, Fed policy, Fed direction, Fed messaging, whether they're hawkish or they're dovish, has more of an effect on and what they're saying looking ahead for the next month or further has more of an effect on the bond market, 10-year Treasury, which is the spread between a 10-year Treasury and the mortgage rates, which track each other, okay, and line up with each other. Should be a 2% difference, okay? So, uh, with that said, here begins my rant, okay? And, you know, did Jerome Powell basically give the wrong information and indicators? So, investors in the bond market, big question was, with them, even without some of the government data, uh, which we have jobs numbers from states, we have the ADP report. We can look at that. We know that the numbers are probably somewhere, if we look at the state numbers of unemployment, we know that the numbers are like 235,000 to 400, or I'm sorry, to 240,000. Where would be the breaking point for the Fed for them to get super dovish and go crazy on rate cuts? Theoretically, about 323,000 or 4.5% or higher unemployment rate. Okay, even 4.6 possibly. We've been running right around 4.3 to 4.4 recently. So, and when they look at the inflation report, which is less of an issue for them right now, according to what their policy is, they're looking at rear view mirror data, old data, old data that actually makes up about a third of the inflation that we're seeing. So, with that said, when we look at those statements, we see that we've also had some other job cuts this week announced in the news, right? We've had Amazon laying off, I think it's 30,000 people, UPS laying off some people. Some people say is it due to AI or not? Maybe when you've got a 1.5 million employees at Amazon, laying off 30,000, although we don't want to see anybody lose their jobs. Maybe, may make sense from a business standpoint, but it also may run cover for a lot of other companies who may be thinking about rate cuts due to the expense of the Fed's fund rate, right? Because businesses, whether you're small or big, a lot of times they'll leverage their money. In other words, they'll borrow money, in order for innovation, in order to increase production, and market their products or services. So, looking ahead on this, a lot of the people, a lot of these companies may be thinking, well, I may start laying off people too if they're doing it. So, that's just what some of the talk is right now in the, economic circles. But it's not the tariffs, it's the Fed's fund rate, which is stifling housing, stifling the entire economy. This 2% number that they're always talking about, that they throw out there all the time. First of all, that's a made up number from New Zealand from decades ago. Okay. As far as the inflation rate. Okay. Uh, you know, and importantly, the point that the more important point is the maximum employment. That's the thing that's really driving these rate cuts, or have been driving these rate cuts recently. Okay, think labor over inflation. Okay, so anyway, and the thing is, the Fed, what Jerome Powell says when he stands up there and bores you to death is that what he says makes up 65 to 75% of what the market reaction will be. Okay. So the bond market's always ahead of the Fed, or in this case, right in real time with the Fed when he speaks. Okay. So poly market, that they do a lot of this, betting on where things are going to be, whatever it is you're talking about. It was a 97% chance that, we were going to have a rate cut this month, and like 97% for next month in December, for the Fed meeting on December 9th and 10th. Well, now, it's down to 72%, which isn't bad, but just the way it affects the markets, we saw that when Powell started talking, the 10-year Treasury went up, so the 30-year average mortgage rate across the country went up a little bit, even though they lowered the Fed's fund rate. So Fed policy, Fed talking points, whether they're hawkish or dovish, is what drives this. Okay. Um, so you've got 12 voting members. It was a 10-2 vote, for the FOMC. So they lowered it from it was 4.2 to 4. Now it's 4 to 3.75. And in December 1st, they're going to stop quantitative tightening. Okay. So that could have an effect too on mortgage spreads. Powell said that, but he said that a rate cut in December is not a foregone conclusion, which of course is a very hawkish stance. Even with terrible jobs numbers, yeah, we don't have all the labor data out, but we know that the new jobs coming in are horrible. We know people are laying off in pretty large numbers. You've got government layoffs, you got UPS, Amazon. Those are pretty good indicators. Okay. Um, and just to show you that Powell is political and not insulated from politics, I'm going to once again lay this out for you. Okay. He was saying the transitory thing, back when inflation was out of control and everybody knew it was out of control. How did you know? You were spending more money at the grocery store and for gas and all that, right? So he literally, right up until the point that he was reappointed, was saying it's just transitory. Don't worry about it. It's just transitory. And convinced Congress, yeah, it's fine. Spend another 2.3 trillion. It's okay. Right out of the gate of the new administration back then. It's wonderful. Go ahead, do it. And what happened? 8 days after his reappointment, he got hawkish and he raised the Fed fund rate. Even though people in our industry back then were saying we should raise the Fed fund rate, because even though we were starting to get decent inventory, stuff was being taken off the market so fast with the super low interest rates. Okay, so and then you had all this inflation coming in, and that inflation, all those giveaways, all that extra immigration we had, that extra demand, took all these properties off the market even faster. So you had like a perfect storm happening for the economy back then, to drive prices up on everything, including housing, and then mortgage rates. Okay, the Fed fund rate, and in effect, mortgage rates, in a very hawkish stance from Jerome Powell. And at first it was the inflation. Then he changed it, moved the goalpost again to labor over inflation, which I get that's part of the dual mandate, but then it was labor over inflation, okay, which kind of gave him more insulation. And then, it was 4.3% unemployment we're looking at. We're fine if unemployment's recently it was we're fine if unemployment's at the 4.5%. And we're fine if we have 0 to 50,000 job openings. Where in the world has anyone ever heard that before? So he's got some political issues. Okay. Whatever you think about the last or the current administration, doesn't matter. He's not being a neutral, I just go by the data number. It's not what he's doing. Okay. It's not what he did. It's not what he's doing now. He was wrong then. He's wrong now. Okay. So, uh, you know, looking at this, just looking at the data. Okay. He's basically saying, the market, he's saying these things and the market didn't like it. Okay. Because the market wants certainty. They want to know, yeah, next, definitely with these, with the way labor's going, the way inflation's coming down, and we know that he knows it's coming down. How do we know? By the way, Stephen Moran wanted a 50 basis point cut, and Jeffrey Schmidt was the other dissenting vote. He wanted no cut. Okay. So whatever, you got some politics all around, right? So, but, you know, Powell is obviously political, and he was worried about his own seat. Okay. So anyways, we'll see we'll see where this all goes. I think he's going to have trouble hiding. If we get some labor numbers before the next Fed meeting and they're not good, and we get some real inflation numbers, uh, one of the things that is definitely going to, I'm going to remind you again, the quantitative tightening that could lower by the end of the year. We could see under six even without Powell. In other words, in the fives. But by Powell stomping on things like he did yesterday, uh, just in a ridiculous, nonsensical, non-intelligent, not common sense way, just like he did back when the transitory nonsense, and just not taking in consideration all the data. Um, he really showed how incompetent he really is. Okay, so we should, we were had that momentum recently. Even with just the spreads getting better, with that quantitative tightening going away, we could see below six in the fives. We were definitely headed there. Now it's kind of like a question mark by the end of the year. So I guess always think the worst, and that Powell's political moving forward until he is the heck out of there in May and done with his reign of terror on our economy and the housing market, So, and the housing market just touches so many different sectors of the economy too, people go out there and buy a house, they're buying furniture, they got to get food, they got to, all the products and services that go along with buying a house and household formation. It has a huge effect on the economy overall and on your local community. So that's why we're always trying to do such a great job for our clients and really show them where these things are at, what's the reality, and really help them through the process because we really care about our local community, and we want everybody to be happy. So we'll see where the momentum goes or shifts here as we get into next month, but. As Logan Monashami puts it, he doesn't really care if anybody owns a home, and certain he needs certain people to be his pawns. Logan Monashami and Housing Wire said that, not me. So, um, anyways, he just doesn't care if you own a home. Now, Realtor.com, Realtor.com, and other uh, you know uh, data driven companies like Zillow, they've all been saying rents have been coming down for the last 26 to 28 months. So we've had real time data at least for the last 24 to 26 months, even with a lag like that. So why that's important is he mentioned CPI in the report. And he's like, I don't really know where things are going to go here, and I'm kind of in a fog of where things are going to be heading. We're not really sure. But at the same time, he says he does know that shelter costs has come down and it will continue to move down. Now we know for the last 24 to 26 months and right now in real time, and it's continuing to go down because shelter data, the way they figure it, uh, with owner's equivalent rent. It's kind of an outdated thing from the 80s. It's absolute nonsense. Wall Street Journal put a thing out over a year ago that we covered, and it's absolute nonsense. But that makes up a third of CPI and the CPI inflation report. The Fed looks more at PCE, which is also a big portion of that. But they look at the CPI, especially right now with a lack of BLS data. Okay. And he said that in the news conference. Again, I'm sparing you the details of listening to him speak. But with that rental inflation coming down for the last 2 years, that's lagging data. He's still looking at old data, but he's sort of caught up now and sort of understanding that it's come down and it's continuing to come down. That's a third of it. So if you take that, and again, like I mentioned last week, you take the services industry where you have uh, basically what people are paid in order to take care of your investments. If you take the real time data on those two things, Our inflation rate for CPI right now is at like 2.1% per Barry Habib and Trueflation. Okay. And both of those people and data sources track way better than Jerome Powell. They got, Barry Habib is a four-time crystal ball winner. If you go on Trueflation and you look at their data charts for the past several years, you'll see that their data tracks and it actually hits more data points than the Federal Reserve looks at. So, you know, Jerome Powell has no working models. He's not an economist. He's looking at old, outdated data. He's political. It's a mess. When we get a new Fed chair, and there should be the shadow Fed, there's five people right now that are looking at it. There should be a person put in place. I would think maybe even before the next Fed meeting with this disaster, or maybe they're going to wait till after the holidays and then get him going. That person is going to start. You watch. It's going to be amazing how Jerome Powell just looks like a complete and utter failure, which he is. Okay. He is the driving force, and other morons at the Fed that go along with him, the driving force for why, we've got all that inflation, all that money printed, and where we are right now. So uh, he was asked another question. This was interesting about the beige book. I'm going to go ahead and share my screen with you here and get into the beige book. This is the Beige Book summary and commentary on the current economic conditions by the Federal Reserve District. And we've got, summary of all the Fed governor and offices and all that. What is the Beige Book? The Beige Book is a Federal Reserve System publication about current economic conditions across the 12 Federal Reserve districts. It characterizes regional economic conditions and prospects based on variety of mostly qualitative information gathered directly from each district's sources. Reports are published 8 times a year. I think the next one comes out next month. Okay. So I don't know about you, but I'm going to look at that and think, quite frankly, I'm going to go with some better data sources. What are those? Well, first of all, my own multiple listing service, okay, and what I can see in the labor economy in my own area. But more importantly, because they're looking at national, of course, okay, what I just explained to you from Realtor.com, I'm going to look at companies like CoStar, Zillow data, Cotality. I'd rather go to these data sources versus the Federal Reserve any day. What does the St. Louis Fed think? Because these other data sources actually all not only through AI and their through their economists and on staff, like I mentioned earlier with Redfin and their conference they had, but the data gets syndicated through these companies from our MLSs, from all the local MLSs. They can see in real time, and they have the history of the data, but they also have the real time data, and they can see what's really going on in real time. All, the rent prices, the home prices. So when it comes to the cost of shelter CPI, being a third of that, I'd rather see, what the projections are from them versus the St. Louis Fed, or, what does the Dallas Fed think? I don't really care. Unfortunately, we're kind of stuck with the current, idiocy and the models that they're not the models that they have or don't have. But I certainly don't want it off owner's equivalent rent, which is again a survey. Somebody calls you up and says, "How much do you think your home will rent for?" A lot of people, even in the industry, off the cuff, may not even know that. Okay. It's again from the 80s, totally ridiculous and stupid way of figuring out where shelter costs are and looking at the real time, the real hard numbers and the real data through these other companies makes a heck of a lot more sense than looking at somebody calling up and maybe getting a response or not, or getting a lagged or old response. And, the lease was signed 12 years back. And what does that got to do with the price of homes that are for purchase? It's total nonsense. Total nonsense. Okay. Um, so it's just not relevant today. It's just not relevant today. Let's put it that way. Which is, with all the data that we have that we didn't have back then, everything being, quick, 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 off the cuff. A lot of this stuff is just right there. We've got the data. We don't need this other nonsense that's old, outdated, antiquated data. So, and this is why the information's 2 years old, and why Jerome Powell is two years behind the curve or more, because he's slow and old. So a couple of these sources would make a lot more sense. Okay, so Jerome Powell has asked another question from Reuters, and if he can't feel that he's getting the correct data, what will he do? With the government shutdown? Ooh, government shutdown. Okay, he can't get the correct data. What will he do if he's only getting private sector data? And he says basically he's just kind of, he says, I'm just not really sure. Kind of, it's kind of in a foggy climate. Not really sure. He says that it may be better to just slow down. Maybe better to just slow down. And that's what he's signaling to the markets. And maybe, just wait, and we'll continue to do our job. But we've got all these places we're getting all this data from. You wouldn't believe all the places we're getting the data from, basically is, his thing that he told another reporter. The markets, business people, the markets, normal people, they want certainty. They don't want that. That's why the bond market reacted in real time. You could see it when he's talking. It went up. It didn't go up crazy, but we were at like 6.13 or 6.19, whatever. Went up to like 6.37. I'll tell you right now. Well, we'll look at it here in a minute. But the 10-year Treasury shot back up. I think it went back down today. But he's saying I'm going to slow down, and hopefully inaction is the right decision because I don't know what I'm doing. Basically, he's just in a fog. I guess I'll have a 33% chance, of making the right decision mathematically, like I'm on a roulette table. And he's got no plan, no decide. People want competent people when they're looking at business stuff, when they're projecting their business, the bond market. You running a household, you want that certainty, right? So it's just a complete farce. Actually, it's a real farce, guys. And he can't be gone soon enough. Okay, so the next Fed meeting again is the 9th and the 10th. We'll see what happens then. We'll see if we get any more labor data before then, if the government's still shut down or not. Here's what happened over the last day. You can see, Jerome Powell talked. Now it's back down again. Okay. So that's kind of how that went. Just ridiculous. This is just one quick headline here. Another hawkish Powell press conference, harshes bond mellow. Absolute ridiculous nonsense, guys. I tell you, looking at the mortgage rate right now, today, we're at 6.33, went up just a hair since yesterday after his complete nonsense. Now, really quick, before I get into the Cromford market data and where we are here in the Phoenix area, I wanted to show you kind of the national numbers on pending sales. Inventories climbed to a 5-year high, giving home buyers more options and more room for negotiation. By the way, if you saw the headlines about, from Redfin, the biggest spreads, the biggest cancellations in, housing history or in so many years. And, there were, the biggest spread, and I'm not saying affordability is not an issue. Obviously, thanks to Jerome Powell, it is. But, especially for first-time home buyers, But they revise their numbers every year, guys. All that stuff's clickbait. That stuff's clickbait. So they revised their numbers back down again, and again, it's more like kind of a balanced market, a little bit of a sluggish market, but we're not seeing anything big as far as any issues there. The chief economist for the National Association of Realtors, he says contract signings match the second strongest pace of a year. However, signings have yet to fully reach levels needed for a healthy market, despite mortgage rates reaching a 1-year low. This is before Powell talked and did his nonsense. Excuse me. Said chief economist Lawrence Yun, a record high stock market and growing housing wealth in September were not enough to offset likely softening job market. Inventory has climbed to a 5-year high, giving home buyers more options and more room for negotiations. Young added, looking ahead, mortgage rates are trending toward 3-year lows, which should further improve affordability through government shutdown, could temporarily slow home sales activity. For the Northeast, we saw a 3.1% increase month over month in housing supply. That's 0.5% increase year over year. Midwest was 3.4% increase. I'm sorry, 3.4% decrease month over month, and then 1.5% decrease year over year in the Midwest. The South, okay, you can see here on the chart where we're talking, 1.4% increase month over month, 0.9% increase year over year. And out in the West, we had a 0.2% decrease month over month in inventory. And we had a 5.3% decrease year over year. Okay. So, um, that's your pending, I'm sorry, your pending home sales is where we are. Did I say inventory? I apologize, but inventory on pending sales. Okay, sorry for the confusion on that. All right, let's get rid of this. And um, looking at the local data, right now we're at 79 days closed on market, 4.9 8 months supply. Basically, guys, that kind of puts us into a balance to buyer market. Depending on the area, it could be a little different. Absorption rate, that's up. That was actually at about 18 just a week ago, 20.09%. Average list price is 744,889. Average sales price was 577,832. And the list to sales price ratio was 97.19%. So people are basically giving up almost 3% on their list price, basically, is what that's saying. We got a little bit more inventory on the market. That's 0.4%. New listings, 1883. Now, normally we like to see that number at about 2,400, okay, for the week. All right. But that's where we are right now. So we're down a little bit. We're down 8.6% there, but overall active is up 0.4%. Pending sales is up 0.5%, and closed units is down 2.2%. This is all your price ranges here, days on market, the percentages, and the percentage change in each of those price brackets. From 0 to 599,999, we've got 67.32% of the entire inventory. And from 600 on up to 1 million, we've got 19.43%. A million plus makes up 13.25%. So there's that. So guys, right now, let's make sure we've got the most refreshed version here. We are at on the Crawford Market Index. We're in a buyer's market. Below 90 is a buyer's market. Over 110 is a seller's market. 100 being totally balanced, 90 to 110 being a balanced range. Our supply is actually up and elevated a little bit. Nothing crazy. Just to give you an idea, we need 3 times the inventory we have right now to get to where we were during the crash. So no panic. You know, back then nationally, we had 250 to 400,000 homes coming on the market every week during the crash. Plus, people weren't, they were losing their house, not buying it. We had a decreasing in sales or decrease in sales prices. So people weren't hurrying right out there to buy a home that's going to depreciate, except for maybe some investors. And then um, you had, for right now, we're lucky if we're breaking, 70 to 80,000 a week for the whole country. So we right now we're nowhere near. There's no crash happening. In other words, okay. So we're at 78.4. That puts us in a buyer's market. The demand is pretty much staying right around this level at 80.9 for us here in the greater Phoenix area. So again, we're in a buyer's market overall. Certain areas are sellers markets, like if you're in Gilbert, Scottsdale, Paradise Valley, those are going to be sellers markets, but nothing crazy. Okay, just a slight advantage to the seller. So guys, if you want more information about your area, hope my rant was okay with Jerome Powell. I hope everybody's starting to understand, how he is really messed with our economy. And some of the people who, let's just say he's in league with or has been in league with, has really messed up, the housing economy as well as the overall economy. It just costs everybody more to do things when businesses have to pass that on, and it costs for them more to borrow capital to leverage in order to grow and innovate and produce more. So I hope that helps, guys. If you want more information about your area, your home value, want to know how we can get your home sold, we've got a product called Zillow Showcase, which is just knocking it out of the park for our clients as far as getting property sold faster for even a higher dollar. It gives your property more pride of place on Zillow, where so many people are on there searching, especially when they're just getting going. It really puts you kind of first place. It gives them additional e-alerts of your property. It does all kinds of things, 3D property tours, all kinds of stuff. And if you're interested in buying a property, right now, a really popular thing is getting buy down rates from builders and or sellers, and where you're getting your rate bought down. There's also ARM products. They're not like they were during the crash. You still got to pre-qualify, and you got to pre-qualify at a higher mortgage rate for these buy down rates and programs. So nothing crazy like they had to do to get rid of all that extra inventory back then. But it's there are tons of ways to save you money right now. We've got new homes starting as low as like $2,100 a month for your mortgage payment with a brand new home. So, guys, if you have any questions at all, feel free to reach out. We'll talk to you next time.